Hi everyone, welcome back to my YouTube channel. And today we're going to continue the book series that we started in the first video of this YouTube channel. And today the book that I've covered for you is my take on the book The Psychology of Money by Morgan Housel, who is a well-known financial writer, and he also did a lot of newspaper and cover letter work in 2008 financial crisis and has had a 15-year career in finance where he has worked for newspapers, Forbes and the best magazines, and he has written extensively on financial crisis, on economy, on interest rates, and how the stock markets work. So I have covered for you some basic points that I took away from this book, and I'm going to share them with you. You also read the book, it's a wonderful book, and please share in the comments about what you learned and what your take was on the book. The first thing I learned was the willingness to be lonely. The author said that in the stock market, like if you go in the historically, even the hedge fund managers, 98% of the hedge fund managers do not beat the index. So, and most of the people today generally try to listen to the market experts and try to get what stocks and what sectors they are investing in, and the people generally like to stay in crowds. If a group of hedge fund managers are bullish on pharma, then people flock to pharma. Or if a major investor has invested in a particular sector or in a particular stock, then people generally flock to that sector or stock. But you should understand that most people who have built enormous wealth in the market have always been people who have taken bets irrespective of how the economy is performing, irrespective of how the sector is performing. Sector does not define the success of any company. No matter what the interest rates are, no matter what economic cycles we are going through, but if a company's management is willing to take risks and is willing to work for the shareholders, and the company is in a sector where they can get a lot of market cap, where the market potential is very huge and the company is very small, and they are willing to fight for that market share, and the company is well positioned, is not highly leveraged, and is well positioned and well poised to grow, irrespective of which country we are talking about. If the entrepreneur and the company, both of them, are ready to take off, the company is going to grow, irrespective of what other people are saying or which sector it is in. That's the first thing that we need to understand. Most people generally feel that to excel in stock market you need to amplify your returns. Like if I'm looking to get a CAGR of 15 to 18%, someone is going to try and take 20%, 25%. People have highly ambitious investment return targets. The thing you need to understand is that all the greatest investors have not taken out like the returns in high 20s or 30s. It's usually they have compounded their money for a long period of time. The skill of the best investors in the world is investing, but their secret is time. If you look at John Templeton, Sir John Templeton, he merely took out a return of 15%, but that was compounded for 50, 60 years. Even if you look at Warren Buffett, he compounded at 22%. But that's a track record of 50 to 60 years that is unbeatable. Even if you look at the best investor in India, Rakesh Jhunjhunwala, he himself says that from equities you must aim to get 15 to 18%, and he himself says that if you get 21% or more, that's the maximum you can get from this market, and try to compound it consistently over 10, 15, 20, 25 years. 1 year does not make any difference in anyone's lives. But if you look at a 15 to 20-year-old perspective, that's where the real wealth is going to be made, and the numbers run wild. People also need to understand the power of humility. We have to chase money not because we need a lot of it, but because we understand that money will bring us freedom of time, control over our lives, and the best return of money is not the what cars we can buy or what houses we can buy, but the control of time that we get from money and the control of opportunities and options in our lives. So people need to stop focusing on what others are saying, what the economy is going to do, or how the country is performing, but they need to focus on what the company is doing, what the management is doing, and what the fundamentals of the company actually are. The next thing that I learned from this book and I found really interesting was that people generally like pessimistic approach to the stock market, because pessimism sounds very fancy. Because when someone is pessimistic that the economy is poised to fall from here, there's going to be a bear market, all these things sound very, they catch the attention of the people, they sound very scary, and people generally think that those who are pessimistic, they are trying to help them. But one who is optimistic, he's only saying this so that other people don't sell in panic and he can continue getting a good return. Because optimism does not sound fancy, it sounds like a sales pitch. So people need to understand that optimism and pessimism, there is no such thing as optimism or pessimism in the market. Stock market is only a place to sell and buy companies, and the value of the companies is decided by investors like us, the foreign institutional investors and the domestic investors, and collectively, because all of us are in the end humans, there's going to be a lot of irrationality in the market. And that is when value investors can plunge and take stocks and companies at very low prices. In the end, I would like to say that whenever we look at stocks, a stock price is tells you nothing. The thing that you need to look at is that the stock is a part of a big business, and we need to, when we look at a stock price, if the script reads 100 but the company is worth 100 crores and it goes from 100 to 110, it may not look like a big jump, but the market cap of the whole company has gone from 100 crores to 110 crores. Now imagine you are buying the whole company. 100 crores and 110 crores is a huge difference. That is where people underestimate the value of buying cheap. There is a lot of difference over a 40 or a 30-year-old investing career if you just slightly overpay for stocks. That will end up in your returns going down significantly. But if you are keen on buying very cheap and buying when the value is fair or it's extremely undervalued, that is when over the long term you can outperform the market. All these things sound very easy, but in reality are very tough. That is why we all need to have a very focused, concentrated portfolio where we can focus on our companies and track them and watch them like an eagle as they're performing. That's all for today. Thanks a lot for listening. Please subscribe to my YouTube channel. Have a great day. Jai Hind.